Hello and welcome to eLagaan Whiteboard Fridays, where we look at various tax and compliance related issues in a user-friendly fashion. Today we will look at a topic called startup tax. This topic has over the last few months has lost a lot of significance because it is not the most hottest topic currently. But why we are talking about it, I'll come to it a little later. So, startup tax was something which was introduced by the finance minister in his last budget, and then it had actually taken a lot of significance. This is a tax which was proposed to be levied on companies which raises money actually more than what it is, its fair valuation is. So the actual name is not startup tax, but since with this provision, a lot of startups and mostly the startup companies would have got impacted, there was a popular word called startup tax which was coined to denote the same. So what exactly is this? See, basically when you form a company, you have a fair valuation of the face value of the share, which is somewhere around 1 rupee or a 10 rupee or even 100 rupee shares. So that's called the face value, that is neither at a premium, neither at a discount. But when you raise money from the investors, then you typically raise it at a very high premium. Now the investors put in money, and there has been a little unstructured way of putting it. They basically put money based on what kind of idea you are coming with, what is your execution strength, what are the potential looks like, how much amount they are putting up. So that's where, so based on the gut feeling, some calculations, some logic, they put up a certain amount of money to buy a certain percentage of stake. Now let's consider your company was with a face value, the company was incorporated for shares with a face value of ₹1. And when you took investment, the first round of it, you took investments almost to the tune of 25 rupees. Now, to calculate the fair value of the company, the fair value of the company could be pretty low. And why that can be pretty low? Because idea is something which is really difficult to value, or the intellectual property is really difficult to value. So you might be looking at things like assets, the liabilities of the company, the business projections, discounted cash flows. But it may be really challenging to prove to the tax authority that you had a fair valuation. Say within a month of forming the company, or within 3 months or 6 months, your company has appreciated to 25 times. Because the work is still in progress, and how it would actually convert to is yet to be seen. So in that scenario, let's for example, the day you raised investments, you could actually do mathematics and bring your fair valuation of the company to be at ₹5 per share. So the difference between the investment value 25 and ₹5, that is ₹20, that actually is called as profits for the business. And that actually goes into income from other sources, which is like, it is not actually a profit from business, but it is an income which is treated as an income. That is what the proposal is. And then if it is treated as an income and you don't have a matching expense, then you have to pay a tax on. And this is again, please remember that this is an income from other sources. So to reduce this, there should be a matching expense onto the other source head, not into the profits of business. This is a little more technical, but theoretically, if you see, there are a couple of buckets in which income is divided, and based on what the source of income is, if the expense is actually matching to that source, then it is allowed as a valid expense, otherwise it is not. So it is not set off against each other kind of thing. So effectively you end up paying tax on 20 rupees, which, say if you are into a 30% bracket, then it could work out to be tax of somewhere around 6.66 or something. So effectively almost 1/4 in this scenario, or maybe 1/3 goes as tax, which is actually called a startup tax. So you end up, say if you have taken say close to 25 lakh rupees for example, and so you have to pay 6.7 lakhs or 7 lakhs as tax on that investment, which is pretty huge. And that also deters a lot of investors, because when they put in 25 lakh rupees, they have certain calculation, okay, that company would actually take 25 lakh rupees and invest in certain manner so that the returns on the business would be much higher. But now the actual amount that is available to the company for investment goes down by 6 to 7 lakh. So the speed, and at the beginning the companies need much more cash to run or sustain for a longer duration. So this could impact the whole prospect of the company in a big fashion. So that's what actually the startup tax is. Due to a lot of debates and representations from angel groups or investor groups, this was actually put on hold, and right now it is not onto a lot of discussion or active consideration. So the government has just said, okay, we are putting it on hold for some time, and let's see how it, and we'll take it up later and see if it really makes sense. So that way, that's why you are not hearing about startup tax anymore. But shortly we are going to cover something on, so there are some new guidelines which has been released by SEBI to boost up angel investment, and so there in some fashion the startup tax is getting covered. So we will talk about it when we talk on that video. So just wanted to make sure that you guys are aware about what exactly a startup tax is and understand this before we move on to that topic. So that's it on today's eLagaan Whiteboard Friday. Please feel free to drop us an email at support@elagaan.com or check our knowledge base at elagaan.com/kb. And thanks for attending eLagaan Whiteboard Friday. Thank you.